Warren Buffett's admonition to be greedy when others are fearful also applies to bonds. I'm Jack Otter, editor of BARRON'S.com. I'm here with Michael Hasenstab, who is the Chief Investment Officer for Franklin Templeton Global Bonds. So I want to talk to you about where you're going, where others fear to tread. But first, could we get your broad outlook for the bond market? We're here at the Morningstar Conference. You've given an interesting speech. Tell us what you see in the next 6 months or so for the bond market.
Well, kind of on the back of what you said about Warren Buffett, I would say right now is a time to be fearful where people are greedy. And there's a lot of movement into interest rate risk over the last 6 months, and we are taking the exact opposite of that. We have moved to immunize the portfolio as much as we can, in fact, get a negative correlation to interest rate risk, because we think rates are going to go higher. And so number one objective in our strategy is avoid interest rate exposure. Number two is selectively exploit opportunities in emerging markets where others have panicked and run from those markets. We have stepped in. So minimize interest rate risk and selectively in emerging markets.
I presume that if you're going into emerging markets, you're taking a little bit of credit risk, but you feel that's okay?
Yeah, so we're buying typically local currency denominated bonds of those countries, places like Korea, Mexico. I just came from Hungary. We think there's some exciting prospects there. And sometimes the dollar denominated debt in a place such as Ukraine.
So the Ukraine obviously is a somewhat scary place to invest with all that's going on. What percentage of your portfolio is there, and then how well are you being rewarded for taking that risk?
Well, I think when there's conventional wisdom of fear and panic, that is when you have an opportunity, provided there are good underlying fundamentals. And Ukraine was really those two factors coming together. On the one hand, you had universal panic and fear and some messy headlines. On the other hand, the underlying fundamentals in terms of their ability to pay back their debt, their access to global capital, which was very positive. Their debt to GDP was right around 40%. They have 30 billion
coming. Nice for the U.S.
That would be nice. So low levels of debt, as well as access to international capital markets, and a lot of fear in the marketplace, and that debt was yielding typically right around, well, anywhere from 8 to 13% over the course of the last couple months.
That is impressive. And so Korea, you also mentioned, that economy is humming along pretty well.
You know, Korea will probably grow close to 3% this year. They're running almost a 6% current account surplus, and similarly, don't have a lot of debt. You know, right around 30% debt to GDP. So a rapidly growing economy, current account surplus, appreciating currency, and by buying short-dated government debt, we can earn around a 3% yield without taking interest rate risk in a credit that we think has good fundamentals.
So I have to ask you about the 800-pound gorilla, which is China. Now, that economy obviously has been growing at an incredible speed for decades, 10 to 7%. Obviously, people quibble about the numbers. But it strikes me that at some point that's got to end. I mean, that doesn't go on forever. Are you worried?
Well, absolutely. The 10 to 12% growth we've seen for a decade doesn't go on forever. And what we're seeing now is a deceleration as their economy becomes larger, as it shifts away from just an investment-led to more of a consumption and investment-led economy. We are seeing those rates begin to decelerate, which is a healthy dynamic. China today growing at 10% would overheat. China today should be growing more like 7%. And we think, given the current structure of their economy, given the ability of the government to facilitate any restructuring that's necessary in the banking system, given higher wages leading to better consumption, 7% growth in the next 1 to 2 years is certainly achievable.
And so you own sovereign debt in China?
Actually, we don't own anything directly in China, but as you said, it's the 900-pound gorilla that affects the world. So if you own any risk asset, you're long China. A hard landing in China would have such ripple effects globally that you always have to take into account what happens in China. But quite directly, places like Korea, which sells cars and automobiles and ships to China, or Malaysia that sells palm oil to the Chinese consumer. There are many countries that are benefiting from a healthy Chinese economy.
Michael Hasenstab, thanks very much.
My pleasure, thank you.